Good morning, class. Today we're going to be talking about a few traditional and modern measures of financial performance. So, why do we even have these measures? Basically, shareholders want to know how much wealth have they generated from the business. So, the increase in worth of a business, as in capital appreciation, or the money that the company gives out as dividends, that is share buybacks or dividends, is what is generated as a return for the shareholder. Now, financial performance measures help us to see how effectively the resources are being utilized. Now, there are basically two types of performance measures that we have for financial performance measures of a company. The first one is historical accounting measure, which only looks into the fact that financial ratios historically what they have been and what has been the historic performance. Whereas the modern shareholder wealth creation measures, like shareholder wealth creation, they focus more on theoretical concepts of cost of equity and weighted average cost of capital. We will just look at them one by one. So, traditional methods of measures of financial performance are the first and the foremost, the simplest of them all, ROI, net profit divided by total investment into 100. This basically measures that what was the profitability or the use of the capital in a given time period. Now, the only deficit of this is historically this is looking backward, and it encourages short-term decisions because profit is mainly determined by the difference between revenue and cost. So the company might actually take measures that enhance revenue, but actually might be detrimental for their long-term growth. So this measure of only using net profit would actually be detrimental because you won't be looking at the holistic picture of the company. We'll be just be looking at maximizing the revenue and minimizing the cost, which might come at the cost of environmental damage, various other forms of negative externalities. Right. So this is earning price ratio. This is the ratio of earning per share divided by the market price per share. This basically shows for every rupee that we are investing in a given company, how much is the company's earning basically. So how much are we ready to pay for 1 rupees earning of a company? The lower PE ratio, the more undervalued the company is because people are ready to pay a lower value for every rupee that the company is earning. Overvalued companies would have a higher PE. That would mean that for every 1 rupee worth of their earning, people would be ready to pay a higher price for their shares. Now, this is an important concept because this basically determines with how we should invest and how long should we invest. So PE ratio is basically showing, suppose a PE is 20. It basically means that if the company's earnings continue and persist at the same rate and the same amount per share, then in 20 years we will be able to recoup our investment. So lower PEs are preferred. But then the question arises that why do they have a low PE? If they have a justifiable reason, it is fine. But if they're actually, you can see market mispricing behind it, then you can really find an opportunity for investing. Now, these are the model measures of financial performance. The first one is shareholder value added. So, shareholder value added is net operating profit after tax minus cost of equity capital. Now, here we are particularly looking at the cost of equity capital, as in what kind of return have the equity shareholders earned. Now, if you not understand the whole concept of cost of equity capital, you need not worry. It is a concept that I'll be introducing again in cost of capital lectures in the following series. Right? But basically, how much our profit was over our capital employed or the cost of capital is basically what is shareholder value added. Then we have economic value added, which is net operating profit after tax minus capital employed into WACC. Weighted average cost of capital is the overall cost that we are paying basically to use all our funds. It takes into consideration the cost of debt, the cost of equity, and various other costs. So we are multiplying it by the capital employed. What we're implicitly doing is that we're only taking that cost of the overall cost, which we're actually consuming in the form of debt or equity to finance our business. Right? Then we have market value added, which is market value of equity and debt minus capital invested. So as you know, share prices have a fixed face value. So for example, a share might be 10, but it might be trading at 14,000, 15,000. MRF shares are actually known to be trade over 1 lakh per share, right? So the market value of that equity plus market value of debt. So even debt securities trade on a platform, right? So what debt mutual fund invests in is basically these debt securities, and they have an inverse relationship with interest rates. So if the interest rates go up, it means that now there'll be more lucrative opportunities to invest, bringing down the market value of our current debt issued. Right. So this inverse relation actually affects the value of the debt or the book value of the debt, meaning that we are trying here to measure as in what is the excessive value for the equity and the debt of the company trading in the market, in a secondary market, compared to the actual capital invested. Right. This is the gist of the difference between traditional and modern measures. Traditional measures look at accounting profit. They're short term, they're limited, they're simple, and these measures are basically return on investment and PE ratio, earning price ratio. Right. Now, modern measures are more economic value and shareholder value. Okay. So we had discussed this concept of shareholder wealth maximization, and we have discussed this concept of profit maximization. Now, if you look at all the methods of modern measures of financial performance that we have used terms such as capital employed, weighted average cost of capital, market value of equity and debt. So we are not only looking at the fact as to what has been the historical performance of profit. We are also taking into fact what are the multitude of factors that affect the price of a company. So for example, the price of a company might actually be affected by the fact that whether a damaging environmental report has come about the company or not. So if we want to lower our WACC or cost of equity, we will not only have to look at the accounting dimensions of profitability, we will have to look at the holistic business, the business as a whole, and whether its value, share price, or value of debt is enhancing in the market or not. It has a long-term view, modern measures of performance. It explicitly considers cost of capital. So here we actually develop a notional concept called cost of capital. Now, cost of capital is a notional concept because for debt, there's a very distinct cost of capital which is very explicit and has to be paid in the form of interest. But talking about equity, one would assume that equity has zero cost of capital, or the only cost of capital for equity is the money or the money issued for issuing the shares, right? So that is not actually true. What the cost of equity is the expected return that the shareholder is expecting, so that the prices of the shares do not fall, right? So that is being taken account into the modern measures of performance, financial performance, right? Modern measures of financial performance are complex because calculating cost of equity is a theoretical amount. Weighted average cost of capital includes cost of equity, which is again a theoretical concept, right? And market value can be easily extracted from the share market data or from the debt market trading data, but they're slightly more complex compared to simple measures like ROI or EP ratios, right? So uh, we have economic value added, market value added, and shareholder value added, right? So now we're going to move to the next topic, that is financial decision. Now, financing decision is very important because it affects the long-term growth of the firm. So how and where from where we raise the money actually influences how well are we able to utilize them in the company and how much profits we're able to generate. In financial decisions, usually these are long-term decisions. So large amount of money is involved. So we'll be dealing in like crores, thousands of crores, hundreds of crores, right? There's a risk involved. There's a chance that the investments that we are making might not pay off. So that risk also needs to be considered, and they're irreversible decisions. Once you take a bank loan or issue capital, it is very hard to buy it back or repay that loan. So once the terms of repayment and raising of capital are locked in, they remain somewhat in a limbo until they are changed, and even if they can be changed, they are very expensive to be changed. Right. Financing decision is basically deciding the optimum capital structure. Capital structure is nothing but what is the mix of debt and equity in our business. Right. There's a trade-off between risk and return whenever we choose debt or equity. Debt has higher risk and higher risk, but comparatively has lower costs also. But equity has very little risk, but given when we'll see the concept of cost of equity, we will see the cost of equity, logically speaking, always has to be more than the cost of debt. Because whatever risk the debt holder is taking, the equity holder is taking more risk than that. So the equity holder would only hold the share price of the company steady or keep investing in the share in the given market price of the company if it is getting a higher return than the debt holders, right? So it is basically deciding whether the company should use its own funds like share capital or retained earnings, or whether it should borrow funds. So financial decision is basically this decision between how much debt should be included in the capital structure and how much equity or common stock ownership should we have. Right? These are the factors that affect our financial decisions. The first one is cost. Cost basically means what are the charges that you have to pay to raise the funds as well as to maintain them. So we are talking about interest here, issue prices here, premium on redemptions, all those kind of costs that would be incurred for raising, repaying, and maintaining that basic loan amount or the capital that we have raised from the market. Risk, right? So if a company has stable cash flows, it can take more risk, it can take on more debt. If it is asset heavy, it can take more risk. But asset light businesses that do not have a continuous flow of income, they're more risky and they should prefer going for capital financing measures such as equity. Right, so this is why you see all these tech companies having rounds of equity issues and moving to higher and higher valuation, because they realize that they don't have assets to back it up to take loans, and they know the business is risky because they don't have a laid out clientele or a solid brand presence. So they need the money, so they raise it via equity. Cash flow position: if the cash flows of the company are regular and it can easily service debt. Therefore, if the cash flows are regular, it should go in for debt. If the cash flows are irregular, then it must go in for equity. Control: equity. Whenever we issue new equity, we lose control over the operations of the company, because all major decisions are made by the management of the company under the oversight of the board of directors, and the board of directors are appointed by the shareholder. Now, shareholder is given voting right in proportion to the number of shares that he holds. Now, if we issue new shares, there will be a liquidation or watering of equity. As in, there will be new owners in the company and my share in the company would go down. Right? So, with how much control am I ready to cede to a stranger or to another party is a question that I have to ask when I'm raising equity. And if I want to retain control over my business, I should go in for debt and not equity. Conditions of the market. So, if the market is booming, going in for equity makes a lot of sense, because what that basically does is that gives us a higher value for every share that we are issuing out to the shareholders, right? And if the market conditions are downwards or adverse, then debt can be considered. Okay, these are the broad long-term sources of finance, right? Long-term finance is basically defined as finance that is required for 10 years or more. It basically consists of the money that we need to buy fixed assets, plus hardcore working capital. Now, hardcore working capital is that working capital which you do not withdraw. So some amount of money is going to be always be needed in circulation in a business. The money that can actually go up and down is called fluctuating working capital. Hardcore working capital is capital that working capital as in cash, in receivables, inventories, that we will have to maintain for the smooth operations of a business. Then medium term is a term exceeding 1 year but usually less than 5 years. It has financing decisions like advertising decision, how much should we raise for advertising budget of the company, right? And short term decisions are decisions for less than 1 year. Now, equity share capital. Equity share capital are actually the owners of the company. They are the primary risk bearers of the company. So if the company goes bust, as in it is not able to repay any of its loan, or it goes into liquidation, the equity shareholders are entitled to the residual profits and residual assets of the company. As in, only if some money is left after repaying all the debts of the company in case of liquidation, or if any value has been left after paying interest for that year, would an equity shareholder be eligible to take that money, right? They're the real owners of the company because they are the ones who actually have the control and are actually taking the risk for the company. How do they have control? They have control by choosing the board of directors, who in turn attune or look over the overall performance of the management, whereas the management looks into the day-to-day performance of the business. So it's a very complicated hierarchical structure where people who rely on the performance of the company are actually in charge of the company to the greatest extent, right? So and the uh, residual earnings of the company, right? And in case the profit is insufficient to actually be able to pay any dividend, then they're not entitled to any dividend. So dividend is not a legal obligation, it is a choice of the management. Whether it wants to distribute some of its profits to its shareholder or not is a decision that the management or the board of directors will take, not the owners. So the owners can only vote and express their dissent over the fact that they were not given dividend, but they don't have a right to claim dividend from the company. Right, then we have preference shares. Preference shares are shares that have a preferential right in repayment of share capital at the time of liquidation as well as payment of dividend. So basically, dividend to equity shareholders cannot be paid until a dividend to preference shareholders has been paid at a fixed date. Right. So preference shares have preference in case the company is winding up. First, the full amount of the money invested by the preference shareholders would be redeemed, paid back to them, and then the actual the remaining claimants would be given a chance. Debentures are basically fixed rate interest charging instruments that draw from the profit and loss of the company, and they are floating charge over the asset. So there's a difference between specific charge and floating charge. Fixed charge of specific charge means that if an asset is sold, the first right to its proceed goes to the one who has that fixed charge or specific charge. But floating charge would mean that the money would be collectively realized, and then so they can not stop the company from selling any particular one asset, but what they can do is they can actually whatever resources are pooled or whatever money is received from selling of the assets of the company, they have a claim over that. Plowing back of profits is nothing but retaining the profits that we have earned. Now this is one of the cheapest sources of finance, right? And how much we can retain would depend on the dividend policy of the company and the age of the organization. Older organizations that have a dividend policy of paying fixed percentage of the earnings or fixed rate of dividend, as in rupees worth of dividend, would have different effects when they declare that they are plowing back profits, right? So it is a permanent source of fund. Once we have retained a source of income or retained a part of our income, we need not worry about ever having to repay them back. Now, it can absorb unexpected losses. So what can many times happen is that the company might endure unexpected loss. In that case, the retained earnings can be used to tide over the company, right? There's a greater degree of operational freedom and flexibility because there's no risk associated with retained earnings. We don't have to repay it to anybody. There's no risk of default. And the equity shareholders are also not losing any kind of ownership of the company or control over the company, and therefore there is no dilution of control in the case of retained earnings. Now, there are certain disadvantages of retained earnings. The first and foremost is that the shareholders will be dissatisfied. Now, shareholders want and need regular dividends. For example, an retiree might want actually regular dividends from his shares so that he can maintain his day-to-day expenditure, right? There's an uncertainty of source of funds. So, what we mean by uncertainty of source of funds is the company cannot know exactly how much earnings will it be able to retain. So, exactly how much capital would be available to invest at the end of a period is not known until that period is achieved, right? And the suboptimal use of funds. So what happens is, because we are not having any explicit charge or any explicit dilution of control in the case of retained earnings, the management might actually become reckless with the projects that it is investing in, and might invest in projects where the rate of return is less than the cost of equity, that are non-profitable projects that generate negative net present value cash flows for the company, right? Now, long-term loans are basically loans given by a financial institution to a company for a particular tenure. They usually have a specific asset attached uh, to that loan amount. So, for example, the business would first make a business proposal, as in how it means to use the money that it is raising. Then it would apply for a term loan, right? Now, whether that term loan is given or not would vary from project to project. And the assets of the company that are used to raise that term loan would be specifically pledged, as in they'll be acting as collateral for that particular term loan. Which would also mean that what would happen is that if the company wants to sell that asset against which it has taken a term loan, it might need the permission of the lender or the bank that has given it the loan. Now, the advantages, obviously, from a taxation point of view, the interest that the borrower pays, basically that is a tax deductible expense, as in the borrower can deduct it as his expense before calculating the profit on which taxes need to be paid. And they do not lose control, because obviously when we're issuing debt, we are not letting off any voting rights or any control of the company. Now, lenders, it's beneficial because they get a fixed rate of return, as in a certain return for a particular maturity period. They have collaterals to keep themselves safe, and they can introduce many restrictive clauses. They can keep the company from selling assets that are pledged as collaterals. They're called covenants, the covenants of a debenture or a term loan. So these are rights that are given to the lender to protect his invest, so that the borrower does not manipulate the amount of money that he has taken from the loan, and does not misappropriate them. Then there are certain disadvantages of term loan. A periodic payment has to be made that is obligatory in nature. So if you default in making a payment for the term loan, you can go bankrupt. It is a legal obligation, and the company has a right to to go to court and demand the payment of the interest as well as the principal. And if it is not made, then they have a right to file for bankruptcy. They have a right to force the company to whom they have given the loan to file for bankruptcy, so that the assets of the company would be sold and the proceeds would be realized and paid towards the principal as well as interest, right? Usually what happens is that if a loan remains unpaid for a very long period of time, the lender is given a chance to appoint a member to the board, so that, because the lender is also interested that the board does not take any decision that is detrimental to the loan amount recovery. So a loss of control might happen if the company starts to fail to meet its debt obligations, right? Okay, now what happens, we see this particularly in the theories of cost of capital. as we take on more and more loan, we become a riskier and riskier business. So new equity would be available to us at a higher rate of equity or cost of capital. Now, there are certain disadvantages to the party who's giving the term loan. They have no voting right, and securitization is this concept where they say that what you can do is that you can um bundle the loans that you have given and then sell the loan as a portfolio to another investor and raise funds immediately. This asset securitization is not allowed in case of most term loans. So the bank cannot club them together and sell it to an investor to get money immediately. Right. Now there's lease financing. Lease financing is a contract where the lessor says you can use my asset and he charges the rent for it and he gives up the right to use the asset in favor of lessee, the one who's taking the lease. Right. Now, whether the asset would be returned at the end of the payments of lease is a decision that is dependent on the terms of the lease. So there can be operational lease and there can be functional lease. So in one lease term, you get the asset to you get to keep the asset at the end of that period, and in the other case, you have to return that asset after all the lease payments have been made. Right. Then the equity shares. Now, there are certain advantages or potentialities of equity shares. The first one is that a large amount of money can be used with no fixed obligation. Right. Once we have raised the money, other than the projected reasons for which we have stated to use the money, there's no obligation to use that money for that particular fund. We might redivert that money to more profitable avenues, projects, or investments. Right. Managers have no statutory is mandated by law. Right. Statutory obligation would mean that there's no legal obligation to repay or distribute the profits of the company. They can retain it, right? And uh, so even if they retain all the profits of the company, the shareholders do not have any recourse or they can't do anything about it just because the dividend hasn't been declared, right? Now, so when we are issuing equity shares, we do not need to mortgage our securities, as in we do not need to keep our security as a collateral, right? Now, what happens is as we issue more shares, the ownership stake in the company becomes, you can say somewhat, the company becomes more free to be able to take loan because it is not already short or tied because of covenants of a debt to not be able to take more loans. So there's more flexibility in taking loans if we equity finance, right? And it strengthens the credit capacity of the company and it considers the maneuverability and financial structure. So if we have equity, we have an option of taking debt. But if we have debt, then the next lender would be very careful about giving us the money because we have already taken on more loan than one can handle. Right. So it enhances the bargaining power of the company while dealing with prospective suppliers. So if the suppliers know that we are well funded and will not be sued for bankruptcy because of debt obligations, we can actually fight with them on a better footing or bargain with them on a better footing about the price of the commodities that we are buying from them. Right? It keeps the top open as for senior managers in the event they change. Okay, in case more finances are needed, there's an option. There's an option to take on more debt in in case of equity financing. Right? It appeals to a large number of investors who are venturesome and are willing to assume more risk for larger income. Exclusive privilege of reigning benefits of prosperity and progress of the business. So what happens is that investors are also deeply interested in investing in equity because they hold a higher chance of getting a fixed return. Or no, sorry, not a fixed return. They hold a higher chance of getting higher returns for the additional risk that they're taking. Right. The danger of issuing equity share is that it might actually lead to the company losing control because new shareholders would be added and the ownership would be diluted or the watering of equity would happen. right? Current stockholder and okay. So what might actually happen is that current shareholders might not want to invest in a company that is continuously raising funds via equity, right? And the problem with equity is that it is a more expensive form of capital. Why is that? We'll see this in the concept of trading on equity. Basically, for the same level of income, if we use debt because of its tax deductible benefit, it costs us a lot less to use debt instead of equity, right? And okay, if the company actually is is invaded by new shareholders, they might lose the opportunity to actually raise additional funds also. Because what might happen is that the additional new investors might say that, okay, we do not want you to take loans. So the ownership, the flexibility, as well as the freedom of the board to take decisions or the concentration of the shareholders so that they can take decisive action actually goes down. Right. Now, this is what trading on equity actually means. So we will assume two capital structures, right? One is equity of uh, 1 lakh at the rate of 10. The second financing structure is 5 lakh worth of equity and 85 lakh worth of debt. The debt has an interest rate of 10%. Now we have the same earning before interest and tax, that is 2 lakh. Now the interest expense, there would be no interest expense in a capital structure without debt. But in the case of capital structure with debt, 10% of the amount of debt that we have raised would be charged as interest, which is 50,000. Making a earning before tax in one case of 2 lakh and in the other case of 2 lakh minus 50,000, that was the interest that we had paid on the debt, to 1 lakh 50,000. Now, loan taxation would be calculated as 30%. This is something that we're assuming that the company lies in the 30% bracket. So 30% of 2 lakh would be 60,000, whereas 1 lakh 50,000, 30% would be 45,000. So net income after tax in without debt would be 1 lakh 40,000, whereas in case of with debt would be 1 lakh 5,000, right? Now, the number of shares in the case of without debt firm are a lot more. The 1 lakh shareholders. So earning per share would be actually earnings available, that would be 1 lakh 40,000, divided by the number of shareholders, that is 1 lakh, that is 1.4. But what happens in a with debt structure is that the number of equity shareholders are lower. There are only 50,000 owners. So 1 lakh 50,000, 1 lakh 5,000 would be divided across 50,000 owners. That would make the earning per share 2.1. So by including leverage into our capital structure, we have enhanced the profitability of the company. Now try and understand what happens is that leverage increases the magnitude of the impact of profit or and loss, profit as well as loss on the performance of the company. Now in this case, if there would have been a loss of 2 lakh, the earning per share of the without debt company would have been 0. But the with debt company would have actually incurred a loss to the tune of minus 2 lakh, right? And even if that is distributed along the 50,000 shareholders, the negative impact would be far more adverse and it would be levered higher because of the inclusion of debt in the capital structure, right? Now, preference shares are a hybrid between debt and equity, right? They have dividend, but they have dividend at a fixed rate and they do not enjoy voting right. Right, there's certain kind of special preference shares that have a feature of voting right, but we will be discussing them in the future. If preference share dividend is not paid for several years, then preference shareholders in certain cases have a contractual right to appoint a board member and have some voting power. Right, now they receive a fixed amount of dividend, right, and the dividend is only paid if there's a profit. Again, this is a concept that I have already explained, that the preferential holders have a preferential right over the equity shareholders, not over the bondholders, only the equity shareholders. Meaning that in case the company goes bankrupt, the first tranche of money or the first pool of money will be paid to the debenture holders. But before the remaining can be divided between the preference shareholders and the equity shareholders, the entire capital amount invested by preference shareholders would have to be paid back. Only then can the residual or the remaining profit be distributed to the equity shareholders. Right? There are certain disadvantages. They do not enjoy voting rights. Right? And so if the interest rate rise, the lucrativity of preference share goes down, because we could have assured a return, a fixed return on our investment by issuing debt at a higher rate, because the interest rates have gone up. We are assuming that. Whereas in the case of preference shares, if the interest rates have gone up, then our opportunity cost of capital has just increased. So, for example, if I receive a preference share dividend payment of 15%, for example, and the interest rate were 12%, I was at a 3% gain from the actual interest that I would have earned by giving a loan, which is a good proposition to be in. But if the interest rates goes up to 18%, that means that I can actually have earned more interest or more income with a more short receipt of income. For example, if the rate was 18%, I could have earned 18% on every 18 rupees on every 100 that I have invested. And that would have been far more than the 15 that I had initially, 15% of return that I had initially locked in for the preference shares. Right? Now, there's certain benefits of preference shares to the company. Because preference shareholders do not have voting rights, the company is able to retain more owning within the company, ownership within the company, and the ownership does not get diluted. Right? The callable preference shares. Now, callable preference shares are preference shares that can be repaid before their maturity if the company feels that it has a right, it has the sufficient amount of profit to buy back those shares. Right? So they trade usually at a higher dividend rate and a higher return rate, because they have the additional risk of their money being repaid at any time and do not know the tenure for which the money would be invested. So in case of the company having a bump profit, instead of just it being an additional source of dividend for the company, for the preference shareholders, it might actually lead to, say, the preference shares holders capital being paid back, and their investment being prematurely closed. Right? It reduces the cost of capital. So again, the cost of capital usually follows the structure. The cost of debt is the cheapest source of fund. Actually, the cost of retained earnings, just keeping our profits back for repayment, is the cheapest source of fund. The next best source is debt, because it has a tax shield advantage. Then comes preference shares, because the rate is fixed, and because relatively they are taking lower risk compared to equity shareholders, they would even be satisfied by a lower return. Whereas cost of equity is the maximum, because equity shareholders are taking the maximum amount of risk for the company's operations and existence. Right? These are the types of preference shares that we have. These are the bases on which they can be classified. They can first be classified on the basis of convertibility. They can be convertible or non-convertible. Preference shares that are convertible can be converted into another security at the end of a period. So, for example, the preference shares might be allowed to be turned into equity shares of the company. Now, why would the preference shareholder do that? Suppose he's receiving a preference share dividend of 15 rupees. Now, it might so happen that the company's price might appreciate by 20%, 30%, 40%. In that case, the preference shareholder would be in a better position trading his preference shares for equity shares that are generating higher returns compared to preference shares that are generating fixed amount of return. Then they can be non-convertible, as in once they're issued as preference shares, they cannot be converted into another form of security, such as debenture, or for that matter, even equity. As per redemption, they're redeemable as well as irredeemable preference shares. Redeemable preference shares are preference shares that have a fixed tenure, and they would be repaid within the lifespan of the company. For example, if a preference share is issued for 10 years, Then after 10 years, the principal that had been raised from preference shares would be paid back to the preference shareholders. This is a redeemable preference shares. Irredeemable would mean that the preference share money would never be paid back until the company winds up. So only in case of liquidation or bankruptcy of the company would the preference shareholder capital be paid back, or else it will forever remain within the capital structure of the company. Right. As per dividend, they can be cumulative, non-cumulative. Cumulative dividend would mean that if in 1 year they do not get the dividend, they're entitled to that dividend in the next year when there is profit. And rather, this cumulated dividend has to be paid. Right. And till the time it is not paid, dividends cannot be declared to the equity shareholders. Non-cumulative would mean that if there's a loss-making year, then what would happen is that the right to dividend would be lost. So, for example, in the case of non-cumulative shares, what will happen is that if a dividend is not paid in a non-profit making year, the right to dividend would lapse. As in now the preference shareholders cannot claim any share of the dividend in the next year. Right? Participating as in they might have participation to the additional profits of the share over and above the fixed amount of dividend that they would receive. Non-participating would mean that they will not have any claim over the residual profits of the company over and above the fixed amount of dividend that they have received. So, in case of non-participating preference shares, the shareholder will only receive the fixed amount of preference share dividend that has been declared. Right. So let's get down to debentures now. Now, debentures are debt instruments that are not backed by collateral. So there's no fixed asset given as a collateral for issuing debentures. The term is usually greater than 10 years, right? Uh, Now, because they have a floating charge, right? As in they do not have a claim over inflows coming from the sale of a particular asset in case of bankruptcy. They usually while buying debentures, the investors look into the credit rating of the company, right? And debenture can be called a type of bond, but it is unsecured bond, right? So on a debenture, a regular payment is made, right? What happens in the structure of a debenture is, suppose you invest 100 and there's a 10% interest rate on a debenture. The first year you will give the company 100 rupees, and then for the remaining life of the debenture it will give you 10 rupees every year, and at the end of tenure of the company, the principal would be repaid. 100 rupees would be paid back, right? Now try and understand, there's a reinvestment risk in debentures, as in the additional money that you get, or the additional payouts that you're getting every year, whether you'll be able to reinvest them at the same rate of interest or a higher rate of interest in the debentures at which they're currently coming from, is the off chance that you're taking, right? Now, usually debentures are formed by a document of indenture. Indenture is a legal and a binding contract. It basically indicates as to what are the terms of the loan. What is the rights of a bondholder? Can it stop the company from issuing more debt or not? What is the maturity dates? All these terms and conditions, rate of interest, are listed out in the indenture, right? Now, the advantage of debentures is basically that they carry low rate of interest and have a longer repayment horizons. Now, debentures, regular interest has to be paid, right? That is one of its advantage, right? Uh, they can be convertible debentures, so fixed obligation can be turned into a floating obligation by converting a debenture into an equity shareholder after a particular period of time, right? In case of bankruptcy, the advantage to the debenture holder is that his money would be paid back first, right? The disadvantage again is that there's a fixed obligation, and whether a debenture can be raised or not depends on the creditworthiness of a company. And debenture returns for an investor might actually go down if the inflation increases, because the real rate of return will come down, right? Now, these are the risks that a debenture is exposed to: inflationary risk, the chance that the prices would rise, and the real return, as in the purchasing power of the money that we are actually earning from the principal invested in a debenture, might actually go down. Interest rate risk, because we are receiving regular payments from the debentures. In case the debenture interest rate goes up, the debentures market value might actually go down, because now the investors have a better avenue to invest in at a higher rate of interest compared to the debenture that you are currently holding. Means as the interest rate rise, the demand for a debenture would fall, because debentures have fixed rate of interest. Now, because their demand would fall, they are exposed to the risk that the interest rate might change, thereby changing the value or the returns that we are generating on a debenture. There's a default risk. What might actually happen is that the company is unable to pay the loan that it has taken or raised in the form of debenture, right? And treasury bond is a form of debenture, but it is a debenture issued to a government entity, and not to a corporate entity, right? So these are basically the differences between shares, debenture, and bonds. Shares are fractional ownership of a company. Debentures are long to medium term loans that have a floating charge. Bonds are something like debentures, but they have a fixed charge, right? Shareholders are the owners of the company, whereas bondholder and debenture holders are the debtors of the are the creditors of the company. The company has taken a loan from them. Now, for a share, the company pays dividend, whereas for interest and bonds, it pays interest, right? Now, how the shares perform depend on how the share market is doing, and exactly what is the demand and supply dynamics of the shares of that company. Whereas debenture and bonds have a stable return for the investor who is investing in debentures and bonds, right? Shares are highly liquid. They can be turned at any time into cash by selling them on the secondary market or the stock exchange. Whereas debentures are slightly less liquid, right? And bonds obviously cannot shift ownership at all, right? Shares have credit rating in them. So whether you invest in a company of in the shares of a company or not would depend on how they're credit rated. Even in case of debentures, because we have a floating charge, uh, we would have what is called a credit rating that would be critical, right? In the case of bonds, credit ratings are not that important, because what happens is that we start looking at the fact that our investment is secure. Based on the types of debentures, we have these classifications, right? Based of securities, there can be secured and unsecured debentures. Secured debentures act exactly like bonds. There's a fixed collateral and an asset, the sales proceeds of which will directly go for the repayment of that particular debenture. Unsecured debentures are debentures that have a floating charge, so they are not backed by a particular asset for repayment of principal, right? On the basis of tenure, they are redeemable, as in they would be paid back within the lifetime of the company, or irredeemable. That is, the debenture amount will never be returned within the lifetime of a company. Only when it winds up will it be paid back. On the basis of convertibility, there can be convertible debentures and non-convertible debentures. Convertible debentures can be converted into another form of security after the lapse of a period of time, right? Whereas non-convertible debentures will remain debentures throughout their life. On the basis of coupon rate, the specific coupon rate debentures. So 8% debentures would mean that 8% return would be given every year to the shareholder. Zero coupon rate debentures are basically debentures for which no interest is paid, but they're sold at a heavy discount. So, for example, a debenture of 100 would actually be given to you or issued to you with a zero coupon rate of say 80, and then it would be redeemed at power of 100, meaning that the difference between 80 and 100, 20 rupees is what I will earn, and the debenture will not pay any interest in the intermediate period. On the basis of registered debentures is a type of debentures for which a list of debenture holders and how they're being traded between the debenture holders is kept. Whereas for a bearer debenture, anyone who bears the debenture or the debenture holder can be a claimant to the interest to be received from the company. Right. So this is the order in which repayment happens in case of liquidation of a company. First, senior debt is paid, then subordinate debt is paid, which is also called mezzanine debt. Then hybrid financing, that is convertible debentures, convertible equity. Then preference shares are paid off, and then finally common equity shares are paid off. Thank you, class. That's it.